G'day guys, Christori here. Today I'm going to show you the value of compound interest and how you can secure never work again money. And at the end of this video, I'll reveal what I believe to be the world's best asset for compound interest. Okay, so the natural disclaimer before I start, of course, is this isn't financial advice. This is just for educational purposes. So for each of the investment opportunities I'm going to go through today, I'm going to use as a baseline $10,000 as initial deposit and 15 years as the number of years. So for the first example, I'm going to use a bank. So at a bank, if you put your money in a high interest savings account, about the best you can do, at least in Australia, is 0.25% as an annual interest rate as of today. So if you have your money in the bank for 15 years, you get a total of $382 in total interest. So that's assuming the interest rate remains the same and doesn't increase or decrease alternatively. So looking at that, you'd be thinking, well, if you're aware of the rate of inflation and how your buying power diminishes over time, putting your money in the bank and just working a 9-to-5 job, putting money in the bank and never deploying it, it's not a viable investing strategy. And it's going to mean that you're never going to be financially free. And ultimately, when comes the time that you're going to retire, well, you're not going to have the passive income coming through that's really going to allow you to sort of go through to the end of your life. You're really going to be relying on the age pension, and that's not the scenario as an investor that you want. You really want to be self-sufficient and have a passive income that'll see you through to the end of life. So the reasons that you might consider having money deployed in the bank would be perhaps to pay bills firstly, but otherwise maybe you're saving up for a deposit for whether it's a primary place of residence, maybe it's for an investment property, or otherwise perhaps if you're a stock or crypto investor, you might have a bit just sitting there just in case there's a significant dip in the markets, in which case you can use that cash sitting on the side to buy up the dip. So they're the sort of reasons you'd have money in the bank, but certainly over the long run, for me personally, I won't for a 15-year period have certainly over $10,000 or even $10,000 just sitting there doing nothing, making no money. I really want to see my money compound, and you'll see that really with the next investing opportunity. So with this investing opportunity, so this is called a first mortgage lending investment. So I do have a position in this sort of investment, and this is something I've used really as a form of passive income and a way really just to, I guess, get a greater amount of cash flow coming into my bank each month. So again, using the same idea, 10,000 as an initial deposit, number of years is 15 years. As of today, the annual interest rate on average across those investments I have in this opportunity are 6.75%. So if I've got the money locked up for 15 years, I could get a total of over $17,000. So that's a pretty good sort of total interest, and it's a viable way of investing. So basically, if you're after a passive income where you can just really lock your money up, don't touch it, just let it keep accumulating and compounding over time, this is a sort of viable investment opportunity. And if we look here at this graph, you can see that over time, it's getting steeper and steeper and steeper. So this is the power of compounding. And you can see if we go into the numbers and if you look at the total interest and how that rises over time. So with each passing year, that total interest, you can see that it's going up by greater multiples each year. So this is really the purpose of compounding and why you want your money working for you. So because you've got those opportunities really just to, I guess, have your money deployed somewhere and really create more income. But of course, the downside with this sort of investing opportunity is that you're really not benefiting from capital appreciation. So my initial deposit remains my initial deposit, and I'm only really adding to that with the interest that I'm earning. So whereas if I was to buy maybe an investment property, maybe stocks, maybe crypto, well, I could see that $10,000 initially invested become in 15 years, maybe it becomes $20,000. Where it just grows. So if I ever want to sell that off, well, I've got that 20,000 to sell down perhaps. So as that initial deposit. So, and also I might also, for those sort of investments, be earning sort of a rate of interest as well, or getting some sort of return. So that's sort of the downside to this. But if you're afraid of the volatility of the markets and you're really scared that say if there's a 50% dip in crypto, or maybe it's a 10% dip in stocks, maybe you freak out and maybe you want to sell when the prices are going down. So maybe in that sort of circumstance, this type of investment might be a more suitable type of investment for you. So, and for me personally, I just use it as a passive income source. And having enough invested, it means that basically I could drop my second job tomorrow if I wanted, because I'm getting a suitable I've got that cash flow foundation where I've got that flexibility to make those decisions. And at some stage or other, I will need to drop my second job just because I do have ambitions of having a family in the future. So having this sort of passive income source, it's a reliable income that can keep coming through. And basically just allow me to, I guess, have enough cash just coming through so that I can keep investing and keep allowing my money in other investments to keep compounding. So I do like the reliability of this sort of source, but of course it's far from the optimal because you're not getting that capital appreciation. So if I go into Google and look at forms of compound interest, so if I look at this website's top 7 picks, so we've got here, these are some examples of some opportunities. So you've got certificates of deposit, high interest saving accounts, really they're low interest saving accounts. You've got rental homes, you've got bonds, you've got stocks, treasury securities, and you've got REITs. So you've got real estate investment trusts. So the ones that appeal to me personally, and it might be different for you at home, but the ones that at least I look at as financial instruments that I would be utilizing. So you've got rental homes firstly. So I believe that property is a great investment if you know how to use debt as a weapon. So as long as you can really, I guess, keep using debt and keep leveraging to get more and more cash flow positive property, you can get yourself to financial freedom. So really, it's a great way to really boost your income, but also get dramatic capital growth at the same time, particularly with the opportunities to leverage. And really, in terms of leveraging, property is the only market that I would actually feel confident really, I guess, using debt to really buy more of something. So I really do have that level of belief in property as a sector, but of course you really need to make sure you've got that safety buffer there just in case property values dip or if interest rates go up dramatically. So they're the things you really need to be aware of and really sort of have those appropriate sort of safeties in place to make sure that you're in a very comfortable position and you can really manage the risk you're taking on by making that investment. The other ones that appeal to me, so stocks. So if I'm locking money away for 15 years, I'd probably be looking at an ETF. So really probably an index fund. So maybe something like an S&P 500. Maybe for Australian investors, maybe it's the A200, it's the ASX 200. Though I don't really have a great belief in the Australian market to necessarily want to put money into that. But they're the sort of stock opportunities that you could look at really as those long-term plays. So, and look, for me personally, I'm more interested in really the growth stocks because they're the ones that keep sort of reinvesting in themselves and they get really the greater capital appreciation over time. Whereas the dividend stocks, they're really paying out distributions, which really hurts their scope to grow as businesses. So you do have to be mindful with dividend stocks in that respect as well. So, but yeah, certainly stocks are very much a viable opportunity because you can get both the growth and also you can get the dividends coming through. And REITs is sort of a similar story as well, where you can get both the growth and the cash flow over time. And with REITs, look, because with rental properties, it is pretty hands-on. You do have those managerial responsibilities. Even if you've got property managers, you have to be liaising. You've got really a lot more sort of to do. Whereas with stocks and REITs, you can be quite a lot more passive in the approach, where if you're buying an index fund with stocks, you can just set and forget. You don't have to think about it and you can just let it keep earning income. And similar story with a REIT, where if you pick a good one, you can really just set and forget, buy it, just hold it really forever. So they're the opportunities amongst these that I rate personally. But what's neglected on this list, and I think this will be quite common for a lot of investing websites, where cryptocurrency isn't really valued as a compound interest investment opportunity. And I think that's really neglectful, and I think it's really a missed opportunity. And I think at least crypto could well be the best compound interest opportunity. So to take you through the first one. So if we look at Cardano, so this is one of the most popular proof of stake cryptocurrencies, and we've currently got a rate of 73% of all Cardano is staked. So there's a lot of really vocal Cardano advocates, and understandably so. And to an extent, I'm one of them as well, for the record. So, yeah, so at the current price, so it's got a price listed here of $1.05. So if we deploy $10,000, you would be getting, you've got 9,523 ADA. That's how much you'd get. So hold for 15 years. If the average interest rate is 4.3%, so you'd have a total balance of over 18,000, and you'd be getting over 18,600 as your total return. So that's pretty good. So you're getting a good rate of return, and you're getting a pretty reasonable APY. And there's other proof of stake cryptocurrencies you can get a higher APY. So, but this is of course just one example of a proof of stake cryptocurrency that's well known, popular, and has hopes sort of for the long run to be quite strong. So, and look, if you're buying at $1.05 today, after 15 years, you'd be certainly expecting some level of growth. So in the short term, it could well drop further. You don't know, but this is actually quite a discounted price compared to recent price levels for Cardano. And this is of course US dollar value. So perhaps in the future in US dollars, maybe it goes up to $10. And if so, well, if you're getting this sort of rate of return, so you've added this much ADA to your collection, and if it's if you've got a $10 ADA, well, if you sell that, you're doing really well. So cryptocurrency is absolutely a viable compound interest opportunity, and really one that shouldn't be overlooked and really needs to be acknowledged as such. So Cardano, Polkadot, Solana, just to name a few of the big proof of stake cryptocurrencies, they're among the opportunities where you can get good staking rewards. And with Polkadot and Solana, you can actually get higher APYs than Cardano. But whether it's going to grow at the same rate, maybe it grows more, maybe it grows less, you don't know. But there are just a few sort of examples of some of the big proof of stake cryptocurrencies. Okay, so next up. So in my opinion, this is actually the best compound interest opportunity if you've got an incredibly long time horizon and you've got that patience and you can delay gratification. So with Hex, so we've got a current price of 17.8 cents. So if you use 10,000 American dollars, you can buy 56,179 Hex. And if you invest that for 15 years, which is 5,479 days, and I'm not going to assume any price appreciation here, I'm just going to assume prices stay the same. And I do believe, for the record, there will be price appreciation with Hex over the next 15 years. But assuming no price appreciation, these are the results we get. So by investing in Hex today at this price, you'd be getting, basically, if you extracted it, over 71,000 American dollars. So making $10,000 into $71,000, that's a pretty great return, to say the least. So we've got an APY here of over 41%, and you've got a return on investment of over 600%. So phenomenal numbers. This is what you want in terms of a long-term investment. But what I would be mindful with Hex is longer pays better. So if you only deploy your Hex for 1 year, you're going to be getting a piddly APY. And with Hex, and this applies for all cryptocurrencies, but Hex to an even greater extent, price volatility is a factor. So you could get in the future maybe a 1 cent Hex for all we know. So, and that could be a year from now. So if that happens, well, you're really losing out quite significantly, and you'll be having a cry about really, I guess, getting a poor APY of only probably 10%. For doing so, maybe a touch over, and I can go through those numbers in a minute. But you'd be having a cry about that. But if you have that longer term time horizon, you're getting the higher APY, and you're benefiting as well from basically more people being invested in the market. So yeah, with a Hex. And the thing to know with Hex as well is you're actually going to get Hex on 2 chains. So it's currently on Ethereum, and Pulse Chain will be launching soon, and you'll get a mirror image of whatever you've got on Ethereum will also end up on Pulse Chain. So if you're holding 56,179 Hex, well, guess what? You're getting a copy of that on Pulse Chain. So in terms of the total payout, you'd actually be getting a total payout of over 140,000 from that initial $10,000 invested, assuming, of course, that the price on Pulse Chain reaches parity with the price on Ethereum. And my personal opinion is that the price on Pulse Chain over time, not initially necessarily, but over time, the price on Pulse Chain, I believe with the lower fees of transacting, staking, ending stake, I think it'll be slightly more expensive on Pulse Chain and a bit more accessible on Pulse Chain. So that's for people that are buying now, and if you're buying before Pulse Chain launches, you can get that opportunity and that advantage. So yeah, so that's phenomenal stuff. So to use an example, so let's say the value of Pulse dipped to, I'll see if it allows me to do these numbers, but let's say it dropped to 1 cent. So these are the sort of outcomes that you could get if it dropped to 1 cent. So that would mean you'd be getting $4,000 back on your money. And if you're getting Hex on both chains, well, then it ends up being basically $8,000. So that's not the end of the world, but certainly it's suboptimal. So but alternatively, over the 15 years, so let's see what happens if we go with a $1 price for Hex. So these are the sort of returns you can get here. So if we play around with the figures, if Hex appreciates over time to $1, and for me, that's a very conservative estimate. I think Hex will go quite a lot above $1 in 15 years from now. But assuming that's the case, a $10,000 initial investment would be worth over 402,000 American dollars. And then if it's Hex on two chains, well, it's over $800,000. So they're the sort of incredible returns that are possible with Hex. And let's say you've got the shorter time horizon. So let's say you've got 365 days and we go back to the price of 0.178. So you've got longer pays better. So for a 1 year investment, you're only really getting a 12.6% increase in how much Hex you've got. So look, that's pretty good. But the important thing to know with Hex is really, I guess, to get into Hex, you're paying gas fees. So maybe you're transferring from USDC to Hex. Well, you're paying gas fees on Ethereum to do so. To stake, you're paying more gas fees on Ethereum. And to end stake, you're paying more gas fees on Ethereum. And if you want to convert it back to fiat, again, you're paying more fees to do that. So to get back to, say, a USDC or whatever your choice is. So given that, with Hex, I would encourage people to have a very long time horizon. So you could invest for 5,555 days to maximize your APY, and you could be getting over 41%. So phenomenal stuff. And you've got here, that's over 72,000 US. So again, at the current prices. So if you get Hex on two chains, that's over $144,000 US. And you don't have to check things really. You start the stake and then you end the stake at the end of the 5,555 days. But the things to be aware of. So Hex is the ultimate delay and gratification play. So it's not for everyone. So if you want to take out your money early, don't be buying Hex. So if you want to end your stake at the halfway mark, you're only really at the end of the day getting your principal back. So you're losing all that interest, which will end up going to other stakers. So look, given that, that's not how you want to utilize Hex. And if you end up ending your stake even before that halfway mark, well, you're cutting into your principal and you're not even getting your principal back. So they're the things to be mindful of. So with Hex, only ever deploy money that you won't be needing for that period that you're staking. So, but with Hex, you're really playing on the hope that the price appreciates. And ultimately, I believe it will, because it's a pre-viral cryptocurrency that has substantially better, I guess, fundamentals, where you're going to have more people wanting to buy than sell over time, because you're going to have long-term stakers. And I think over time we'll have more people staking, which will actually reduce the APY, but it might actually increase the price pressure and maybe actually make the price go up by quite a substantial amount. So in terms of a long-term store of value, and also from a compound interest perspective, I think Hex is really the best play out there, particularly if you want to go the passive route and not build through property. Thanks for watching, guys, and if you enjoyed this video, make sure you like, subscribe, and hit the notification bell for future updates. And if you're a Hexican, make sure you get behind me. Same if you're just a cryptocurrency fan in general. Maybe you're into Pulse Chain, PulseX, maybe you're a Richard Hart fan, or maybe you're a fan of proof-of-stake cryptocurrencies and think they should really be more widely spoken about by people in the financial space. So, because personally, I'm a big crypto advocate. I am a fan of all the Richard Hart projects, and there's also other cryptocurrencies that I've got positions in and that I also advocate quite strongly. And I will be making more cryptocurrency content, as well as really going through more general investing fundamentals as well. So anyway, guys, see you in the next video.